Minneapolis Fed President Neel Kashkari delivering on his promise to offer a plan to end too big to fail in America with a proposal to massively increase capital requirements on banks. Guys, you got to see these numbers. In a four-step program, one, he would raise large banks' equities, bank capital to 23.5% from the current level, which many think is too high, 13%. And that's only step one. If the bank is still seen as systemically risky, he would raise it in 5% a year all the way up to 38%. Step three, put a shadow banking tax on of 1.2 to 2.2%, depending upon how big the shadow bank is. Step four is cut regulations on community banks smaller than $10 billion of capital. Kashkari said, quote, "The biggest banks are still too big to fail and continue to pose a significant ongoing risk to our economy." He said his plan will reduce the chance of another bailout in the next 100 years from what he says is currently 67% under current regulations to under 9% once his most stringent capital requirements are in place. Kashkari acknowledges his plan will have a high cost, a huge cost. In fact, he says it'll cost 41% of GDP, but says it is still less costly than what another banking crisis would cost the economy. The Minneapolis Fed president also says it is the specific intention of this plan to get banks to break up and become smaller. Of course, the plan comes out at a time that bank stocks have rallied on the hopes of less regulation and lower requirements or capital requirements on banks. And we're going to have a chance to ask Kashkari about this when he joins us tomorrow morning live on Squawk Box.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.